Ben Reppond. Today is June 5th, 2024. Welcome to my YouTube broadcast. Going to start with the dashboards. The first one, this is as of last Friday, which was the last day in May 31st. And you know, if you follow these, these are 6 major indexes plus the bond index, TLT, which is the 20-year long-term government bond index. And I show these performance. In the yellow box is the last week, and in the pink box is year to date. To the right of that, to the right side of the chart, are red dots and green dots. If it's a green dot, it shows that it is above its 20, 50, 100, 200-day moving average going from left to right. And then if it's red, it's below that average. Those tend to say if it's red, it is, indicates more of a bearish tone for that index. And if it's green, it, is positive. Looking at the top to bottom, S&P 500 represented by SPY, QQQ, the NASDAQ 100, EFA, the developed markets, EEM, the emerging markets, DIA is the Dow Industrials, and IWM is the Russell 2000 small cap index. So you can see this last week in the yellow box that they are mixed. Some are positive, some are negative. By far the one that moved the most was the emerging markets, and it's down over 2.5% for the week. On the year to date, the S&P and NASDAQ are similar. Then you drop down to the developed markets, emerging markets, etc. At the very bottom is the long-term government bond, TLT, this is the ETF, and all 4 moving averages, it is below all 4 moving averages, and it was a negative week for that for that bond. So, and year to date is down over 8%. So it is struggling. Bonds are struggling. Why are bonds going down? Interest rates and bond yields are going up. They tend to go up. They tend to move together. So as interest rates go up, bond yields are going up, and the price of bonds. The intermediate term, short term, long term, nearly all of them are going down. And that does not spell good news for buy and hold portfolios. When you break the S&P down to its 11 sectors, these are the 11 sectors. Again, I do the last week in the yellow box and year to date in the pink box. And this last week there were 3 negative and the other 8 were positive. The most positive was telecommunications and energy. I always count the dots. I think it's an indicator. So there are 44 dots. Of those, 34 are positive, and therefore 10 are negative, compared to 32 that were positive last week. Okay, let's take a look at the S&P 500. This is from October of 2022. So this is about, what is that? 20 months or so. So you can see the trajectory is, generally speaking, positive, and the degree to which, this is a weekly chart, the degree to which the moving average, which is it's a 20 period or 20 week, if you will, moving average, and it is still pretty well below the S&P 500, and you see a slight downtick this last week. This is a 9-month chart of the S&P also. It's a candlestick chart, so you can see, same thing. I mean, it's basically gone up, similar to the past chart, but this past couple of weeks, not much change the week before, and this past week, slightly negative. So there's nothing to me that says this is the beginning of a collapse. I don't think that's the case. it could easily go on up from here, and it may have a correction. I just don't want to speculate on that. But right now, being well above the moving average, I'd say it's positive. When I put the S&P 500, break it apart into growth and value, there's an ETF for each. SPY-G is growth ETF for the S&P 500 stocks, and SPY-V is the value ETF for stocks. That went down this past week, which meant that growth, when it goes up, it favors growth, and down favors value. So it favored value a little bit this week, more than growth. But still, since the beginning of 2023, it is still in an upward trajectory. When on a relative strength basis also, you take the S&P 500 and compare it to the Russell 2000 IWM, and if it goes up, it favors large cap stocks, which is the S&P 500, and if it goes down, it favors small cap IWM. And there was a small downtick which favored small cap this past week. I covered the TLT, the long-term government bond, and earlier, and it was negative this past week, not a lot, but some. But it is in a longer-term trend of going down because interest rates and bond yields are going up. And you can see that movement if you look very carefully at the very end of it, the far right, you can see there is a little bit tick down, and that was the negative value of TLT for the week. The US dollar continues to go up. Again, it's got a longer term trajectory of being positive. So we are the reserve currency of the world. So the dollar versus everything else, if it's going up, that probably means that the other currencies against the dollar are going down on a relative basis. And you can see the move up this past week was positive, not a huge amount, but it was continuing to move and staying above the 20-period moving average. Gold went down a little bit. It rallied a lot in the last couple of months, 2 or 3 months, and then it is in a little bit of a pullback right now. Again, well above its 20-period moving average. Same thing with silver. Silver just skyrocketed since, when was that, February or March? And then now it's got a little bit of a pullback, but you can see how far above the 20-period moving average it is. And then when I put them on a relative strength chart, looking at how is silver doing versus gold, when it goes up, it favors silver, and vice versa, when it goes down, it favors gold. So you can see the big move up to the right, and that is the degree to which silver outperformed gold. It's relative. And then silver has maintained its strength by either being flat or going up slightly, again, outperforming gold during the pullback. Bitcoin has been, since November of 2022, has been in an upward trajectory. Pulled back a little bit last month, last week, but still is above its 20-period moving average and is showing strength. Volatility index has moved up to, 1292 from down in the high 11s. So it's still very low, and what that means is that when it is low like this, you can see relatively speaking, when it is low, that is good for equities. So low volatility is positive. Asbury Research publishes data. This is their Asbury 6 market indicators. All of them are positive as of Friday. They compare assets, certain assets, to one another. The ones that I look at are the ones that are positive for all 3 time periods, the last week, the last month, the last quarter. Those are the last 3 major columns. And low volatility stocks have done better than high beta stocks all three time periods. The U.S. has outperformed the emerging markets, again, all three time periods. This corresponds to some of the data I just showed you. And corporate bonds are outperforming government bonds. Comparing one country to another, not their currency or their economy, but their market, their stock market. We use SPY, S&P 500, as a kind of an indicator for our market, a broad indicator, and there's ETFs for each of the other countries. The countries are listed in the first column and the ETF is listed in the second column. The ones that have outperformed us for all three time periods are Peru, Switzerland, Italy, Spain, and New Zealand. The ones that we have outperformed are Brazil, Mexico, South Korea, India, Thailand, and the emerging markets, corresponding to the previous data that I showed you. Okay, looking at that previous U.S. versus the world chart, I looked at different indicators. The U.S. is stronger than most of the other markets. And so I picked one. I've been using Switzerland, but Switzerland is kind of moving in a category of a little bit more in the short term, a little more outperformance of the U.S. But I found Thailand, and the ETF is THD. This is a chart, relative strength chart, so it is showing the U.S. versus Thailand, THD. And you can see the strength, including the most current last couple of weeks even, the strength of the S&P versus the Thai market. Very interesting. Gold and silver. As of Friday, the gold spot price was $23.30. The silver spot price was $30.42. Both of these are pulled back a little bit, not a lot. The gold was up, or was down 0.2%, and silver was up 0.2%. So again, I showed you that relative strength chart, and you could see that, again, silver continues to outperform. The gold-silver ratio is 77-1, making silver a better buy at this point. But both of them have performed well, particularly with this recent move in the last 2 or 3 months. A monster box, which is 500, you can see the picture of it, 500 rounds of generic silver called bullion, 500 rounds stacked nicely in this box, is $15,785. So if you're interested in buying one, that's kind of about the price you would pay. That includes a $1.15 markup. Now, I just gave you the spot price, but this price includes the $1.15, which is the markup over spot. That brings the total price to $31.57 for 500, including the markup, and $32.07 for 20, which is 1 tube. The average American is getting squeezed, and hopefully it's not this bad, but there's not a lot of money sloshing around, which is why the gold-silver market is, you're seeing a move up in the price of gold and silver, but that's usually not a reflection of supply and demand. What is a reflection of supply and demand, in my opinion, is the markup. So as the markup goes up, that's telling you that demand is increasing. But that's not happening. $1.15 is not, historically, for the last 10, 15 years, is not a lot. So anyway, this corresponds to the data that I showed yesterday, which was that the consumer is getting squeezed, the economy is slowing down a little bit, not crashing, but it's a reflection of the fact that the consumer is 70% of the market, and they're, not everyone, but many are tapped out due to high prices and interest rates and various things that are putting a squeeze on the consumer's pocketbook. Thank you for watching. If you have questions or comments, leave them in the comment section below.